Hi, Mike Swanson here, and I'm visiting with Dave in the Bahamas, and thought we'd visit with you because there's a lot of stuff going on in the stock market right now. The S&P 500 fell last week to the support of 880, and now it's bounced back up. I actually I still have a short position in right at the moment, but I'll probably end up covering it because I got to stop at 920, and we were trying to figure out, what's the next move in the stock market, because a lot of people are sending emails wanting to trade it or go long, and I thought I'd share with you Dave's take on things, then my own too after that.
I think there's two. Well, actually, I put a small short position in too. I bought some of the leveraged ETFs on the short side, but I did it more as a hedge because I'm mostly long right now. So I just did it just to kind of hedge, just in case we got a pullback. I think when you're looking at the markets, one thing that's really important for investors to look at, I've been kind of advocating since the fall of last year, meaning both in the fall and the fall in the markets, that people kind of allocate out of the U.S. because I believe because of the big printing of money and deficit spending and monetization of the debt, the U.S. dollar has got a long way to fall and will go to new all-time lows. And so I've been, like right now, I probably have about 15% of my assets in U.S. dollars or equivalents because I live in the Bahamas and the Bahamian dollar is linked to the U.S. dollars. So obviously my savings accounts are in Bahamian dollars, etc. But I'm mostly out of the U.S. dollar, and I'm in foreign currencies and foreign markets, and I think that's the most important thing to talk about with the market. Yeah, Mike's right. Like I think the market, the S&P looks like it's going to break out here, and maybe might take a plunge towards, or plunge higher towards 950. But it's really important to note that most of the foreign markets, being Canada, Brazil, India, Taiwan, South Korea, all of these markets have broken above the January highs and are really outperforming the U.S. market. And I think that's a real important sea change. Granted, emerging markets fell more in the bear market because they're more volatile, but also like those markets are much even closer to highs in some respects and then the U.S. market. Like if you look at the Dow, this time last year the Dow was trading at probably roughly 12,000, and now the Dow is 8,500, 8,400. And for example, India is now only, because of the big move recently, is only down 10% year over year, rather down 30%. So I think you're going to see this outperformance in emerging markets, and part of the reason is the solvency in the banking systems there, and the fact that they don't have all this leverage crap that the financial institutions own. So on top of just looking at the S&P and maybe the market moving higher, I think on any upcoming pullbacks, you're going to want to look at emerging markets and foreign markets more. I believe the U.S. markets continue to be a laggard. I guess that's what I'm going to say.
No, I definitely agree with that. If you look, the Chinese market and the Indian markets in particular look like they're doing a lot better than the United States, and they have a better base formed out since November. Like when our market made a new low in March,
they held their lows.
They held up, so they definitely look a lot better. But the thing is, like right now, like if I look at the individual sectors in the stock market, and I use this GC2000 software to do that, there's a lot of sectors that haven't really gone up a whole lot, or they've bounced very well, but they're not like making new highs over the last week where the stock market did. But these sectors actually look like they might be better for the long term.
Yeah, like they're basing.
They're basing out, and they're going to be good buy points later in the summer. And for me, like right now, I mean, I get constant emails from people every day. What do I do? What do I do? What do I do? And to me, like right now, there's not that much I see that's great to try to do to make money at the moment. Like I think, basically, people, if they're going to try to make money, playing the indexes, they got to basically day trade.
Yeah, or position trade real, like be it for a week.
For a couple days, a week, and so forth. And that's basically, I think there's better opportunities for the regular investor coming in on pullbacks or this.
Yeah, I think
these kind of sectors. We'll mention a couple of them in a follow-up, about commodities. We'll do a thing about commodities, but
see, the problem is that the gravy is kind of out, like the easy money, I guess you could call it. Because, for example, we were talking about foreign markets, and one of my big holdings has been Tata Motors, the Indian car company that has the $2,500 car, and I put that on my list at $350, $10 a share in just 2-3 months. But at $350, $3, $4, $5, that was the easy money, right? And now I think you're really, if you're going to look at something like that, you have to buy on pullbacks, and you have to be very selective when you're trading some of these things. So I think that's what makes it difficult too, is that even I'm saying that I think these emerging markets are going to outperform, I don't really want to buy them up here, and I want to wait for pullbacks and that sort of thing. And sometimes you just have to be patient like, a pullback might take a couple of months to unfold and happen. So, that's the problem, is that the easy money is kind of out of the market. And then how much is fundamentally based and how much is all this money that flowed into European and U.S. markets, I think is actually looking to go somewhere else, and it will flow into Asia. That's what I personally think. And how much the market's going up is just that, the money flows, and that sort of thing, and that's kind of where I'm at right now. So I'm a little boring right now because other than select opportunities and select stocks here and there, like there's a little holding company that you talked about too that I just bought, some little junior mining thing. I've purchased some recently, but other than that, I'm actually just taking some profits in some of these things, and I'm waiting for pullbacks.
Well, this is more like a time, I think, to do, for us at least, to do our homework on what to buy in the coming months or something like that. But the thing is, like when it comes to investing and trading, the one thing I really believe is you got to have a strategy that's suitable for the type of market environment you're in. And last year, the best strategy was
just be short.
Was shorting, shorting the rally. And I made money doing that. And the thing is, I want to do a video talking about more of this kind of stuff with you in more detail.
Yeah.
But the thing is, like, people like for me, or other people, or whatever, you do a strategy, and when it's working, you keep doing it until it stops working.
Yeah.
And then that's usually a sign the market's changing or something's going on.
I think the biggest...
And right now, I think, for me at least, like I've done a lot of focus on the indexes, and I'm going to end up focusing more on trying to find individual stocks. Probably, over the...
And Mike has this message board on his website, and I've actually posted the opposite of that. I've actually told people, I've actually done little threads on the message board saying, don't be so focused on the indices, because I don't think that's where the opportunity is. Like, everyone's obsessed with trading the S&P 500, and I've been stating actually the last few months, I don't think that's where your opportunity is going to lie. And Mike's right, because, for example, you'll see some guys who are the perma bears or always bearish, and they were, for example, we were looking at a guy, we're not going to name names, but this guy's always bearish, and some market timing magazine ranked him like their top timer last year. That was just because the market tanked. I'm sure he's really doing crappy this year, right, when we've had this big rally since March. So I think the thing is, like you said, you have to be flexible. Like, for example, the best kind of analysts or traders, there's a lot of shorts who've covered, like Bill Fleckenstein got rid of his short funds, right? He basically closed them down because he didn't think there's huge opportunities. Mark Faber, since the market collapsed last November, October, he's been telling people to trade it to the upside. So you have to be real flexible when it comes to that trading, and you can't just look at things. And one thing you really cannot do, and I see people do this all the time, you cannot concentrate what's going on in the economy, because the market always turns usually before or after, or before that, and usually you get big bull market moves starting up when the economy is still kind of weak. So if you look at this number's bad, that number's bad, all that's going to do is keep you from making money trading.
No, and then the opposite happens too. When you get to market top, everything's good.
Good, yeah. So it's funny because I looked at the market at one day where it up this week because consumer confidence was high, and I was like, well, ironically, the best time to buy the market recently was when confidence was right at the low, right? So it's it really is a reverse psychology, contrarian thing when it comes to trading.
But I really think right now it's really tricky, to be buying, because even if we break out here, you go to 950, let's say. And then what happens after that? I don't know.
There's another resistance there.
There's another resistance there. It could go back down to 850 or 800 eventually in the summer. So it's not a great time I think, to try to hold. That's why I say you got to be trading it.
Well, my whole thesis too is that when we bought them in March, was I thought maybe we were starting a mini bull market. That'd be 6 months a year, and it would take the S&P maybe back to 1100. So that's the same thing too. I don't really see okay, at the lows, I thought we had 60-70% upside and 10 or 20% downside when the S&P was 660, right, or 670, 666 at a slow. But then now I think that now it's equal to me. It's got 20% downside, it's got 20-30% upside. So I don't like the risk reward as much as I did 2 months ago.
Well, we'll stop talking about the general market and do a follow up and just talk about gold and commodities.
Commodities, yeah.
So yeah, we'll just stop that one. We'll make sure. Let me see it real quick. All right.